Well, good morning to all of you. Full house. Make yourself in, pack in here close. We expected it to be a big crowd, and Dr. Meyer, I won't steal your punchline that you might share with relative to the crowd, but obviously an important topic to our industry, right? And it's always an important topic to our industry, and probably more so, I would argue, now than it's been since 1998. And so I've got the honor and privilege to introduce two of your speakers today, and I've been given a script, and I don't usually do it the script, but I'll try to stay on script because I know two of the gentlemen very well. First, I'd like to introduce Dr. Meyer, obviously a familiar face to all of you. And Dr. Meyer, I can either give the off script or the on script. Matters how much? Off script, okay, well, it matters how much money you've got. Dr. Meyer is an expert in what he does. And he is a leading economist in our industry and has been committed to this industry for 30 plus years. You've seen him present all over the country, all over the world, and he is one that can even make an animal scientist understand supply and demand, and so I thank him for that. Also then to his left, and we'll speak after Dr. Meyer goes, is Dr. Schulz. I think the first time I met Dr. Schulz, we were in Japan or China, I can't remember, but it was 2017, I believe, and the work he's done at Iowa State's phenomenal. He's an associate professor there and serves as the statewide extension specialist, and so they will both bring a different view of the landscape, but I think a complementary view as well, and so appreciate both of them being here. Before we get kicked off, though, it's important that I share with you the antitrust slide, and so just make sure that you understand that the National Pork Board and the Pork Act complies with the Sherman Act, and if you have any questions relative to certain matter and whether it can be discussed or not, ask an attorney, for whom I'm not, but feel free. And then finally, I would say with this, before we kick to Dr. Meyer, is remember that this is a session hosted by the National Pork Board and the Pork Checkoff, but the presentation in which the presenters and the content in which they'll share with you is their view of the world, and so keep it in context as that. So, with that, Dr. Meyer, it's all about you. Thank you for being here. Give him a round of applause as he comes up front.
Thanks, Brett. Thanks, Brett. It's good to be with you this morning. Big crowd. The line I told Brett was, boy, you draw a crowd when you're going to have a train wreck. So anyway, we'll talk about that interesting story. I think in 1923 or 24, the Iowa State Fair actually staged a train wreck to draw a crowd. So there's pictures of that. Let's get going here. First, it's good to be with you again. It's been a long history of doing presentations at World Pork Expo, but it never gets old to come to Iowa in June and be with pork producers. I work for Partners for Production Agriculture. We are an introducing broker for StoneX, so we have to show you this disclaimer, which Joe always says. What this says is if you trade anything I say, any of the things I say today and lose money, it's your fault, not ours. So let's go on. Key issues for hog and pork markets. Now, we're going to divide this. I'm going to talk about costs and demand, and Lee's going to talk about supplies and prices. And neither one of us has an easy chore today. This is a difficult time, and it's not going away in the foreseeable future. Domestic U.S. consumer level demand was the key driver of the last 2 years. You know, there were a lot of folks said, well, we have high prices because costs have gone up. Nope, that's not the way it works. That wasn't the case. It was blind dumb luck. We ended up with very strong demand at a time when costs went up and kept us profitable for a while. That has now gone away. We'll talk about that. Production costs have entered a new era and are likely not going back. I always hesitate to use the word never, all right? But I'll be very surprised if we see a production cost in this industry that starts with a 7 again, all right? It might happen, but we'll lay out that here in a minute. There are fundamental changes on the grain supply and demand side that are causing this, and I don't think they're going away. Hog supplies have become an issue lately, kind of an issue. I mean, Lee's not going to tell you that we're overrun with pigs, I don't think. And if you look at our supplies relative to history, we're not in too bad a shape, and the March Hogs and Pigs report didn't say that, and we'll get a June Hogs and Pigs report here in a few weeks that I'm going to guess is going to tell us we're in the process of reducing pig supplies. Operational packing capacity could be an issue. It's going to be a little snug this fall, especially with the closure of Wyndham. but not terrible. I don't think that's going to be the issue it was like in 98 or 2016. Prop 12 is now the law in California. We'll talk about that real briefly. ASF still kind of a problem in lots of parts of the world, but we're going on I think 3 years now with it just off our shores in Hispaniola, and it hasn't gotten here, which is good. And then the price discovery system, we had a lot of talk about this 3 or 4 years ago. And then we started discovering prices of $120, and everybody said, oh, well, this is okay. And I would point out that system that discovered prices of $120 is no better than the system that discovered prices of $50 a few years before. All right, it still needs to be fixed. So, Prop 12, the latest big news. The SCOTUS decision, of course, came down 5-4. Prop 12 is the law of California now. It will start being enforced on July 2nd. They delayed enforcement of this thing, but it actually became effective on January 1st, 2022. And so it's going to become very risky to bring non-compliant product into California for sale starting in July. Now, the CDFA has released a couple of documents recently, and one last week, and they had a webinar yesterday, and they haven't clarified the situation on existing inventories, in my opinion, at all. And the reason is they say, well, we're going to devote our time to getting everybody certified by the January 1st, 24 deadline, and that's fine. But there's a private cause of action clause in Prop 12 that means that any citizen can file a lawsuit under Prop 12 against a supplier that's selling product that's not compliant. And you have some district attorneys that will be very glad to go after this. We have to remember that this law was pushed by animal rights groups. They do not want... It's not that they don't want compliant pork sold in California. They don't want pork sold in California. And so we have to keep that in mind. This is still going to be an alter. And what that means is we figure we've got somewhere around half, maybe a few more, of the sows necessary to supply historical consumption in California. On July 2nd, not all of those have been operated in a compliant manner. They might be in a compliant building, but they haven't been operated that way. So on July 2nd, that 14% of U.S. consumption that California has taken, somewhere around half of it, maybe more, probably more, will not be able to get into California. Well, it ain't going to just sit somewhere. It's going to be sold somewhere else, and it's going to put downward pressure on prices. And it's going to add to the situation we already have. This is Iowa State University estimated costs and returns. Lee's been part of this. John Lawrence goes all the way back to Gene Futrell back in the 70s of estimating the cost of returns for farm finish operations in Iowa. And if you look, this was a good 21, a bad 22, not great, and a much worse 23. In fact, if we look at the projected, I don't think I've got that chart in here. I think you've got it later. The projected losses for this year, they're going to rival 1998. Going to be very close to it. So and it's not because of hog prices. Notice where the actual prices and the futures prices here going out through 24 are relative to history. There's only been 4 other times that we had better prices than this. The hog price is not the problem. The problem really is cost. And costs have exploded the last couple of years, and I'm going to talk more about that. Now, so that brings us to today. What's going on for the crop this year? What's the prospects of solving some of this? Well, we got the corn crop planted in a very, very good manner. I mean, we got it done early. It's better than the 5-year average, not as good as a couple of past years, but still the timing on this planting was good. We've kind of stumbled out of the gate on crop conditions, and there's parts of the Midwest that are getting pretty dry. And so we're very concerned about that. Now, if we go to look at soybeans, the same thing. Well, this was one of the fastest planted soybean crops ever. So we really got the soybeans in the ground. We don't know much about conditions here. We've only had 1 week of report on soybean conditions. The point I would make is that you don't make a crop by planting date, okay? It's a good thing to have happen, but it's not sufficient. You still got to have rain on corn in July and rain on soybeans in August, or you still won't have a crop. So we've started off good, but that doesn't mean we've made this crop by any stretch. USDA's balance sheet in the May WASDE report, they're projecting a 2.2 billion carryout on corn at the end of this crop year. Now, there's a few things that are a little iffy on this. One of them, we probably did not get 92 million acres planted, and that will come out at the end of June in the acreage report. This is an ambitious trend yield. Now, that is a trend yield, but boy, it's way higher than we've been the last 2 or 3 years when we've been under the trend yield. So we think that's a little ambitious too. So we think this crop of 15.265 production is pretty ambitious. That's going to be a stretch at a $2 billion carry out, and then you're already still almost $5 on USDA's predicted price. Soybeans, a little more manageable. We got them planted fast enough that we probably got those acres done, and normally you have some corn acres that go to soybeans if they can't get planted, and so that's probably okay. 52, well, we were 51.7 on yield 2 years ago. So that's not as big a stretch as 181. 335 million bushels carry out is good but not great, okay? I mean, the real comfort level is 200, and so we're beating that, but we still got $12 beans. Now, the problem, long-term problem arises here. 480 corn is what USDA is saying, and $12 beans, and the cost of producing corn and beans are both higher than that, okay? So there's not a lot of room here to start moderating your cost of feed ingredients based on what these numbers are as far as projected prices of those items. If we look on the usage side, there's some real changes going on. This is ethanol and kind of the blend wall as we go forward. And, you know, the statement has been made, 2/3 of new cars and light trucks will be electric by 2032. All right? How much gasoline do you sell for an electric car? Probably sell some to run the generator that they carry around in the trunk, but you know, not very much. And if you're not going to sell gasoline, you're not going to sell ethanol. So there's some real challenges for ethanol going into motor fuels. But there is a savior for the ethanol business. It's called sustainable aviation fuel. And this one can eat up anything that we save on ethanol. So we're not going to get a break by ethanol not being produced. We're going to run our plants full. And in fact, if they try to take sustainable aviation fuel from 5 million gallons, 5 billion gallons up to, I can't remember what the number is on it, 3 billion gallons, 500 million, pardon me, 5 million to 3 billion, that's a factor of 600. You know, we might actually need some more ethanol plants if that actually catches on. And I think it's going to because the policy is in there. The other one is renewable diesel. And we've got capacity here, but we're going to triple that capacity over the next 2 or 3 years. And that ship has sailed. I mean, California, Oregon, some others are going to put in requirements for renewable diesel. The Q45 credits are there. And so we think that this is going to increase. And of course, that's already using most of the fats that we produce, the waste fats, animal fats, those kinds of things. They priced them so that we can't hardly even afford to put them in a hog diet now. And now they're looking, saying, well, we need more soybean oil. We need more palm oil. And so all of the growth we're going to have on the soybean side, the oil is going here, and it's going into diesel. Now, the good thing is we have about a 30% increase in soybean crush on its way. 4 of these plants, expansions or new plants, opened this year. There's 3 more scheduled for this year and 7 for next year. So they're on their way to make more soybean oil. Well, what do you get when you make soybean oil? You get a lot of meal. And we thought that meal would already be cheaper than what it is. The problem, of course, this year has been what happened in Argentina. Very short crops in Argentina. They are the major player in world soybean meal trade. And so that's dumped a lot of that business to the United States, and it's kept our soybean meal values higher than they normally would. The only real good news I have for feed costs stretching out in the next 4 or 5 years is that soybean meal is going to get cheaper. We're going to crush the beans for oil. You can't store the stuff very well. Basis is going to be weak, and it's going to change fundamentally how you feed pigs. We're going to feed soybean meal probably for energy. The value of your manure is going up dramatically because you're going to have a lot of nitrogen that's going to go into the pit. And so this is a possible break for costs, but it's not going to be very large in my opinion. So this is Lee's model, the estimated cost and return. This will be cost of production. Now, on top of all this, Lee Schulz screwed it all up here recently. when he went in and he adjusted some of these cost items. Every year, Lee reindexes his non-feed variable costs. Last year, that added $7 a head, okay, for things like labor and fuel and medicines and all the other things besides feed that go into variable cost. This year, it added $2.93. Every 5 years, Lee goes back and looks at fixed costs: depreciation, insurance, repairs, taxes, interest. Any of those 5 gone down recently? No. Of course, they've gone up dramatically, and it added $8 per head to his cost this year. Before about 2 weeks ago, I had this nice little break between the actual and my first forecast. And when Lee adjusted those, I've got a nice continuous line now. I'd rather have the break, but that's not reality. In fact, I had 2024 costs at about $85 for next year. Now the model has 2024 costs at about $90. So these forecasts are mine. They're based off the historic data here, but they're based on corn and soybean meal futures prices and then the other parameters that Lee has in the model at Iowa State. So this is what we're looking at. So we came from 63 to 80 to 95, 97, 90. And that's not the half of it. Lee does a great job, but his cost estimates really represent the better end of the cost producers out there. And we think that average producers are $6 or so higher than what these are. So we're in the $90 range on cost of production for the foreseeable future. I don't see any real breaks on that. We'll get some help on the soybean meal. It's going to be kind of slow coming. As we go through 2024, 25, we'll see some help on that. But we're not going back to here. I guess that's the point. We're not in Kansas anymore, and we're in this new world out here of cost in the $80 plus range. So when you look at that chart of hog prices and you say hog prices are in the 80s, that's one of the better prices we've ever had historically. You still have to compare it to reality on the cost side, and that's not a very good picture at this point. Okay, so on top of all the good news about costs, I'm going to talk to you about demand. Now, demand is a complicated thing, and we economists have language that generally confuses people on this. I used to tell a joke, Lee, about what do you get when you cross the Godfather with an economist. And I don't tell that joke very much anymore because there usually aren't anybody around that remembers the movie The Godfather, all right? The punchline is you get somebody that makes you an offer you can't understand, okay? Which the Godfather said, I'm going to make him an offer he can't refuse, okay? So anyway, we'll try to get through this in an understandable way. Multi-level issues. So let's start at the domestic consumer level, all right? And domestic consumer level demand is one of the determinants of wholesale demand for pork. I mean, if demand at the consumer level is higher, that'll pull up the demand at wholesale. So it's a combination of retail and demand and food service demand, and the derivation from that level back to wholesale depends on retailer and food service establishments and their cost and profits. Wholesale pork demand is comprised of domestic wholesale demand and export demand. So when I do an analysis of demand, I look at two basic ones. One is domestic consumer level demand, and the other one is export demand, because when you put those together, you can derive back using packer profits and costs the hog demand that you face when you're selling pigs. And so it's a multi-level thing. We look downstream to see what's going on. Now, consumer level pork demand is defined as the quantities of pork that consumers are willing and able to purchase at alternative prices. The important items of that definition is that quantities and prices are plural. All right? It's a whole set of quantities and prices. And it says, if we are going to put this price out there, how much will you buy? And if we do put this different price, how much will you buy there? So you got a whole set of these things. It's not just one. Right? There's a negative relationship with them, and the position of that whole set of quantity price pairs is determined by factors exogenous to the pork industry. So, what did I do? Aha, there we go. So, if you have a demand line, this would be the set of pairs of prices and quantities that consumers are willing and able to buy, and then that line gets moved around by other things, like prices of competitor goods. If the price of beef goes up, what does it do for pork demand? It's positive. It helps. There's substitution that happens. The price of beef goes down, it hurts pork demand. Prices of complement goods. Now, this is more a theoretical thing, but if I don't talk about it, they'll pull my economist card. So I throw it in here because it hardly ever comes in as something significant, but here's an example. Did the price of eggs last year at $5 a dozen have any impact on bacon demand? Those are complements, right? My guess is that we'll never see it in the data in a model, but that is a complement relationship, and that's the way that works. Income levels of consumers, and this is the one that's important in today's discussion. When consumers have more money, they buy more of some things, generally more of everything. Taste and preferences is the other one, and that's the black box of what drives people to do what they do. All right, I know some people whose taste and preferences lead them to eat no pork. All right, they are Jewish or Muslim, and that goes into taste and preferences. That's a good example of what goes into that. So then we have this demand line. So what happens when the supply changes? I hear all the time, well, the prices went up and it destroyed demand. Demand destruction. And I go, no. The demand curve is still the same. All you changed was volume destruction or quantity demanded. So you slide up and down this when the supply curve. Now, how do I measure this? Well, I measure it using real per capita expenditures. And so what we do is we look at the real price as published by ERS, and that data is kind of iffy, but it's still the consistent, always there data that we can lean on, publicly available, and you don't have to subscribe to Nielsen or something to try to figure that out. And we use per capita consumption. Now, this is real per capita expenditures for beef, pork, and chicken historically. Why isn't turkey in there? Because ERS doesn't give us a very good retail price for turkey. It's a whole bird price. I think it's quite misleading. It leaves out all their value-added products. And so we just use these three. But notice what's happened in the last year or so. Here's the pandemic when it hit in 2020. Wild gyrations in real per capita expenditures. But we set a record in 2021. We set another record in 2022. But look what's happened recently. We've dropped back to levels that were there before. Now, we're going to talk about that in some specific. In retrospect, this looks to be all income driven. On the left here is real per capita disposable income per person, and you can see wild spikes higher due to stimulus payments. We put trillions of dollars into the economy and into consumers' hands, and they went up tremendously. And then on the right is personal savings. We gave them that money at a time when they didn't have a lot of things to spend it on. They couldn't go to a movie, they couldn't go to a restaurant, they couldn't do this, couldn't do that. A lot of the things they wanted to buy weren't available, right? So it went into savings. But look what's happened to the savings since then. We've dropped real per capita disposable income back to levels actually below where they were before the pandemic, and we've exhausted all those savings that were there. And what has happened to demand? It's changed pretty dramatically. So savings jumped sharply. All of that is now gone, plus some. So in its place, we have this large increase, and I'll tell you to ignore the blue line because they changed the definition there, but what's the red line? This is the money supply, or M2 money supply. And it jumped several $1 trillion because of the cash that had been put in the economy. And what happens when you put a lot of cash in the economy, and especially if an economy is struggling to produce as many goods as it did before? Well, the price of those goods goes up. Too many dollars chasing too few goods, and you get inflation, which further erodes consumer income levels because it reduces the purchasing power of what money that is coming in. And you cause some real problems with consumer attitudes. This is consumer sentiment as measured by the University of Michigan. That's the lowest observation in the history of that survey that goes back into the 1960s, I believe. Okay? So we've had incomes came, demand exploded, incomes went away. We've changed consumer sentiment. We've increased the inflation rate. And guess what? Demand ain't what it used to be. This is real per capita expenditures by species. Now, the interesting thing, and I should have last year's on here, but beef real per capita expenditures started falling relative to a year before, back in the early summer of last year, and it was down double digits most of the second half of the year. Pork demand relative to the year before started falling in September, and it became down 12% at the end of the year. You can see we were down 13% in March. Chicken demand actually grew in the second half of last year. Notice they were up 10% for the year last year. Now, if you're going to shift meat demands because of incomes, if I take away income, which product do you think you'll hit the demand first? Beef, because it's the most expensive, right? And that's what this says. Who'd be second? Pork. Who'd be third? Who might actually benefit from that for a while? Chicken. I mean, these all really fit that it was this income thing that really drove this demand surge. Now, I also have a mea culpa on this, and that is I didn't see it. And the reason I didn't see it is for years and years I've done these prediction equations and tried to predict prices and had an income variable in there, and the income variable, which should determine demand, Lee, was never very significant. Some years it would come in significant, some years it didn't. And so when incomes started growing, I said, well, okay, that's good, but I've never been able to see that they really helped. I overlooked the magnitude part of this. Well, I know everybody else did too. I got a lot of company in this. The magnitude of this income change was so large that it did have an impact. And you can see that pretty clearly now that we've pulled it back out of the economy. So that's the way it is. I mean, we're still dealing with this. Our real per capita availability of pork is actually going down. I mean, it's within the 50 to 52 pound range that really applies all the way back to the 80s. But this tells us that this isn't a supply-induced thing. You know, the fall of 1998 was a disaster for us. We had 10% more pigs and 13% more pork production in the fall of 98. That was pretty much a self-induced disaster. Closing a packing plant in July of that year was a bad part of it. But still, I can't say that this is one of those. We have not overproduced this market. It was something that's kind of taken away. Retail meat prices, nominal. You know, they ran up some during the pandemic. They've kind of leveled off and pulled off those highs a bit. Beef is kind of inching back toward it. If we look at it in real terms, remarkably stable over time. I mean, pork prices just haven't changed that much. Chicken haven't changed hardly at all. A little bit of bouncing around for beef. And then, that's taking inflation into account. We have a weekly retail pork price. Retail prices are still strong. Now, a lot of producers say, yeah, that's bad. We'd like it to be lower. We'd like to be offering a better value to consumers. But the point I make is, even with retail prices where they are, we don't have any pork backing up anywhere. Cold storage isn't getting out of hand. They're selling every pound they can at that price. And so a retailer will look you square in the eye and say, why should I cut the price if I can sell all that I can? And I would say, yeah, that's probably right. Now, we don't like that. It doesn't seem fair, but I think it really is help. Now, if we look at retail price ratios, we can see that those two are kind of in line. The blue is beef to pork. The green is chicken to pork. There's nothing really out of line here at the retail level that suggests that we have anything going on. So if we do a scatter diagram of quantity of pork and price of pork, deflated price, over the years, each one of these observations would be the intersection of a supply and demand curve. And thank goodness they kind of lie in these negatively sloped clusters, Lee. I mean, that agrees with my economic theory training. And it says that we've had the demand jumping around here some, but notice where 2021 and 22 were. They were way off the charts up. Now, I should have an X there, and it didn't come through on this slide. This vertical line is where we're going to be on per capita availability this year, 50.4 pounds. The average price from January through April is 4.13. It'd be about right there. So this says that we've gone right back to the demand relationship that we've seen in the past before the pandemic. So clearly softened since 22, most likely driven by stimulus payments, including enhanced SNAP payments to citizens. What can help pork demand? Remember the factors: taste and preferences, competitor prices, complement prices, income levels. We're probably not going to throw that much income back into the economy. Complement prices really isn't a big deal. Taste and preference change very slowly. The one that probably will have the most immediate impact will be competitor prices. And I'll show you in just a minute, but beef is helping us. Let's go to exports. This could be a positive for sure. We were up almost 12% in March. We're up 8% for the year. It looks like we're going to have growth this year, and I think that's going to be a positive for us. The question is it enough positive? In my book, the answer is not relative to those cost of production levels. Help? Yes. Enough help? No. I don't think it will be. We've seen growth. In fact, the March exports were the highest since May of 2021, and that was really without China participating in our market. So there's still this possibility of China out there. Now, I am not a positive and optimistic person about China. We still have a 25% punitive tariff on our product going in there. If you haven't noticed lately, our relations with them still aren't really very positive. And I just don't think they're going to be back here unless they get completely desperate. We're going to be a supplier of last resort, in my opinion. Now, we do have Mexico, Japan, Korea, Canada, all growing. And, Brett Stewart out at Global Agri-Trends has us up 5.9%, and he kind of keeps increasing that as we've gone into the year. US MEF is at plus 8. Those are all good numbers, but they're probably not going to get us anywhere near profitability. The dollar has weakened some since last fall. It's still on the top side of this trading range it was in for about 7 years. So our product is still a little bit expensive because of the dollar, but when you put that with our actual price levels, we're pretty competitive in most of these export markets, and that's a positive too. So we think exports are going to grow. We work with Brett, and he's forgot more about that than I know, and so I kind of follow him pretty close. China exports, I think, is going to be a real problem. I don't think we're going to. Now, if they buy from anybody, though, it helps us because it opened up some other opportunities, and that would especially be true for Canada, who has had their plants relisted now and can ship some products over there, and that would reduce the amount of product they're shipping down here. Mexico, I think, is going to remain strong, and I put where else will they go, and the answer is they could go to Santa Catarina, Brazil now. Now, they're buying some product from there. I'm still in mind that won't become a major issue for U.S. product going to Mexico. They bought our product when it's expensive. They bought it when it's cheap. They are really quite dependent on our pork supplies at this point. And finally, the big EU output reductions that are going on across the EU and very high prices there are going to open some opportunities for us, especially in Southeast Asia. So if we put consumption and exports and imports and look at the wholesale level, all wholesale product, and the cutout value, guess what? 2021, 22 were really good. 23 is back to the pre-21 levels, just like we saw a while ago. Here's the price ratios that I think are going to make some difference. Beef to pork, chicken to pork. This one is record high. The beef one is very close to record high and almost certainly going to go up. So at the wholesale level, buyers are going to look at this and say, gee, pork's a real value here. And I think that will engender some featuring and some push for pork at some point. It hasn't started yet. We still think it's coming. Okay. Finally, we go all the way back to the farm level and relate total pork production to the national net price of pigs. 21, 22 are an outlier, 23 back where we were before. So the story on demand is pretty consistent here, that we had a really good 2-year period. It's gone. We don't know that it's coming back. As a matter of fact, I would say it's not coming back. Not to that level, because we're not going to have those kind of income stimuluses we've had on that. Relative prices do not point to one species driving demand yet, but I think the beef business is going to. They're going to start rebuilding the cow herd and pulling heifers out of that mix. Many macro variables are still pretty strong. I mean, we've had, how long have we had a recession supposed to start next month? I mean, kind of a long time. Inflation is certainly hurting by being a drag on real income levels. And finally, we think exports are going to help. The real long-term growth for us, we got 10 markets in the Caribbean, South America, and Central America that we have free trade agreements that are going to full implementation. 0 tariffs, 0 quotas. The population of those 10 markets adds up to just about the same as Mexico. So that's a real long-term growth place for us. So, Lee, you get to bring all the good news. There you go, sir.
So I told Dr. Meyer last night that, it's an honor to present with him, but it's taken 11 years. So I don't know if that was his doing or someone else's. But so pleasure to be with you. I think Dr. Meyer had the harder part, demand. Supplies, I think we know a little bit more certainty, at least short-term where we're at, and some expectations going forward. I'll remind us, so this was a National Pork Board project funded not too long ago, done by Jason Lusk and Glenn Tonzer. The question was asked, we've seen nominal retail prices from January 2020 to May 2022 increase 27%. Why, right? We know supply and demand obviously impacts prices, but what else have we been dealing with? Inflation, right? And so they worked through some economic models, and that pie chart shows you the percent of each that contributed to those increases. So when we look at from a percentage point standpoint, those are the right-hand numbers. So demand had been very strong, as Dr. Meyer noted, during that 2020 to 2022. We've seen inflation impact those prices certainly, and supply had a very positive impact on those. But as Dr. Meyer highlighted, demand has changed, right? Inflation, we've started to cool, but we've seen nothing of disinflation, right? We're still dealing with very high prices. And supplies are, for the short term, working against us. We're seeing a bit larger supplies. So this is a balance sheet from the Livestock Market Information Center. What I want you to really key in on here is really those first two columns. So as we look at slaughter numbers, and USDA's projections would be pretty consistent with this. 2023, some modest growth in overall slaughter numbers, maybe 0.5%. So that means the second half of the year we may see a little bit of a cooling in those slaughter levels compared to the first half of the year. But even 2024, right now they're forecasting just a modest 0.1% reduction. And that might seem a bit surprising given where we are with current prices, right? And especially profitability. I'll highlight to you, though, the hog cycle. So who thinks the hog cycle is still alive and well? So I do. Maybe not many other people. But I'll note that the hog cycle today doesn't look like anything in the past, right? We've seen a very flattening of that hog cycle. I'll say some factors that have contributed to that, at least in the short run, reminding folks that pork we're eating today, those were decisions made 10 to 18 months ago by producers, right? We can't shut that supply off. We're going to have to eat through that supply, right? Adjustment of those prices will help clear the market. I think we have asset fixity, we have asset specificity that says effectively the investments we've made in production facilities over the last several years, there's not many alternative uses, right? So we're going to continue to produce. That doesn't mean we're not going to see some tightening of supplies, but we're not going to go back to the large changes that we had seen 20, 30 years ago in that hog cycle. So right now we are up 3.1% the first quarter of slaughter. I think we'll start to ease that back as we get into the next couple of quarters. This is the Hog and Pigs report, pretty dated report. So USDA is currently collecting data for the June 1 Hog and Pigs report that will be released here June 29th. So we'll get some updated numbers. What are the key numbers folks are going to look at? Obviously the breeding herd, right? Are we making adjustments to the breeding herd? What does that have implications for sows farrowing numbers, and then ultimately the market hog inventories? We've seen market hog inventories. I've been reminding folks we really had to give USDA credit. Several quarters ago, they were really hitting market hog inventories right on point. As of late, they've had to make some revisions on there to match where those slaughter levels are. I think what's going to make headlines in this next Hog and Pigs report are these farrowing numbers. So these were very pessimistic farrowing intention numbers by producers, but when were producers asked about their farrowing intentions? March, early March, right? What have prices done since early March? And what have costs done? Haven't changed much, right? So we've seen really profitability erode dramatically, and certainly that has potential implications for that hog and pigs report. Now, as we look at slaughter numbers, so I rely on Dr. Meyer's capacity line there, and so this was the estimate for fall 2022. You'll see what we're tracking here is this purple line. Slaughter year to date has been up 1.3%. As of March 1, it's been up 1.5%. The hog and pigs reports benchmarked it at 1, so they're going to obviously revise some of those market hog inventory numbers and likely some of the pig crop numbers before that. And so one thing I'd like to highlight, and I'm going to come back to this, is we look at carcass weight. So this carcass weights, as we look at producer-owned hogs, so I like to use livestock mandatory reported data of those carcass weights, because one, we get that data very timely, it's almost real time, and we get both the packer-owned and the producer-owned. Now, packer-owned hogs are much higher, typically. I put it on the same axis here, and you'll note that the producer-owned hogs have really fallen well below the 5-year average, as you would expect, right? Hog prices have been suppressed, feed prices are really high, there's not a whole lot of incentive to feed to heavier and heavier weights. Whereas we've seen producer-owned or packer-owned hogs kind of remain at the levels we've seen the last couple of years. I think there's implications when we talk about packer margins here in a bit. I mentioned the farrowing intentions. How pessimistic are they? Well, what producers told USDA back in March about what they intended to farrow from March to May, that would have been the lowest since 2015, and that was their second estimate on that. Now, it was much lower than what they had told them back in December. For June, August, that would be the lowest since 2014. So that's lower than any level that you see on this graph here. Also, one thing to highlight when you look at these farrowing numbers, there's been a bit of a change. When you look at where farrowing numbers were relative to those estimates, they were much higher, that third or actual farrowing number. Now, some of that is USDA making revisions to sows farrowing, because they don't make revisions to the pig saved per litter metric, so you have to increase the number of sows farrowing. I think that's contributing some to that, but also, where we were dealing with much higher prices and profitability here's a situation where we continue to see producers get more and more pessimistic from a farrowing intention standpoint. Now, as I look at that March-May farrowing number, there's going to have to be some adjustment made, because when we look at the utilization of the breeding herd, that's the lowest since 2015, and before that, 2003. So one of two things has to happen. Producers have to say, well, we actually intend to farrow more sows in March to May. How likely is that? Not very, probably. It's probably likely the same at best. Or does that mean that maybe we got to revise that breeding herd lower? Now, USDA doesn't like to do that, but when we look at how that matches up from utilization, that would be consistent with a smaller breeding herd, which would be certainly consistent with the economic conditions going on for producers now. Now, as we look at productivity, so here, and this is from the hog and pigs report, you have pigs saved per litter. We'd been on this really nice path here. Made it great from a forecasting standpoint. You could add 1 to 1.5 increase in pig saved per litter. You take it times the farrowing intentions, you got a good pig crop estimate, and it was pretty accurate. But really, over the last couple of years, that's kind of flatlined to par to maybe a 0.5% increase. The question amongst many of us, analysts included, is, are we going to return to that 1 to 2% increase in productivity, right? And I think there's a lot of reasons why we've maybe seen that, especially when we talk about COVID disruptions and labor constraints that we deal with on farms. Another issue has certainly been disease impacts. I'll highlight here, these are swine disease detection dashboards from Iowa State University. My reading of these, I always cautious to highlight that I'm not a veterinarian, but suggests that we're back to maybe baseline or some improvements as it relates to PRRS, at least compared to maybe where we had been previously the couple of years. So that says maybe we do see some improvement in this productivity potentially going forward. We look at early wean pigs, so these are 10 to 12 pound pigs, and feeder pig prices. I like to show the cash prices here. So you can think about this as really the pulse of that market, right? It's going to respond to signals both from a profitability standpoint and a lack of profitability. I'll highlight here that 10 to 12 pound pigs are as low or almost as low as they were during disruptions of COVID-19. So down averaging $10 per head. 40-pound feeder pigs haven't fallen as far. You know, they're below the 5-year average. Some of this likely has to do with when these pigs are going to come to market, right? And seasonally where we expect some potentially higher prices, but very pessimistic, especially when you look at the wean pig market. So these are my price forecasts. I'm going to set this up, and then I'm going to talk about why this may be a little bit different for some producers. How I like to do forecasts are really so you can't blame anyone. I'm going to list 3 here. So the far left one is the Livestock Market Information Center. You can think about that as very a fundamental-based forecasting. The middle one is USDA, so you got to blame Millie right there. Again, a fundamentals-based forecasting model. The one on the right is me. I'm the laziest one, so I'm going to use futures prices. I'm going to adjust this for a basis. Dr. Meyer always jokes that this is the K-State way, so I don't know what that labels, but so this is going to give you a little bit different perspective on where those prices are. Now they're also going to forecast a little bit different. I'm doing the Iowa, Minnesota because Iowa pays for my salary, so I feel that's important. Nationally, we're going to look at LMIC and USDA will be those. Now, comparing those forecasts, you know, there are some differences. Some of that is time related, right? I get the benefit of being the most timely using the futures price. Not so much for USDA. I believe that'll be next week. LMIC is pretty current as we go on there. So here, you know, LMIC and futures base are maybe a little bit more optimistic for 2023, but again, that may be USDA updating here in this next week or so. As a composite, this shows prices lower by about 20%.
Hey, Lee, can you tell us what the annual price is there? We can't read it.
The annual price for 2023?
Yeah.
So 78 on average. I think the range there would be 76 to 81. Be a consistent average on that. And then, you know, as we get into 24, at least for the first quarter, maybe an average of 79, which would be a modest increase of 4% there. Now, Dr. Meyer highlighted earlier, you know, we're coming off historically nominal highs, right, or close to. 2014 was our high. Actually, 2022 for a bit of time, we were forecasting higher prices in 2022 than in 2024. We did see a little bit of a late year swoon in prices, and that brought it down slightly compared to those historic highs. But as you look at 2023, you know, that's still relatively high nominal prices in that range of probably the 4th to 7th highest prices we've seen. Now, if you picked up, I talked nominally, right? And what we also have to talk about is inflation adjusted or real prices. So that's what this highlights here. These are USDA's cash receipts. So this is both price and quantity. So hogs marketed, we're still marketing a relatively large number of hogs and at modest prices, right? And so nominally, these are some of the highest receipts producers are ever going to receive, right? Modest prices, relatively high marketings, but when we take into consideration the dollar, so what those dollars earned can buy you, it's much less, right? And we have 2014 is obviously much higher there, but 2023, you know, is still in the top 10 or so as we look at those receipts. So Dr. Meyer highlighted this is not necessarily a price issue, right? So these are those estimated returns back to 1974. This was actually a very interesting exercise. I wanted to get them back as far as I could go. I think I could get them back to the 80s. I had to go to the Iowa State archive to go get the other ones. But that gives us this whole series of these returns. And if I do the average over this whole time period, what do you think it is? Pretty close, right? Pretty close to 0, as you would expect. It's a very competitive industry. Profits are going to lead to expansion. We're going to bid away those profits and get to lower inventories and higher prices, and that gives rise to that cattle or the hog cycle. Now, as we compare 1998, in my estimates, 2023, at least from an annual average, could be potentially the worst year ever, nominally in history. So we look at these receipts or these returns back to 1990, 1974, 2024, at least through the first 10 months, is still well below break-even levels. Now, I want to highlight a few differences, maybe comparing back to 1998, or at least why these returns maybe aren't as bad as I'm potentially showing here. So one important distinction is the manure value is tremendous right now, right? In these estimated returns, I measure it as a credit, right? But you can think about this as reducing my commercial fertilizer bill, right? And what had been roughly $2 to $4 per head, I'm estimating is more in that $8 to $12 range now per head, and this is after application, so this is truly a net value for that manure credit. So that helps offset at least my crop enterprise and expenses there. And so when we look at it from a whole farm standpoint, that helps, right? Now, prices aren't all equal either, right? And as Dr. Meyer highlighted, we talk less about price dispersion and price discovery and determination when prices are high and much more when prices are low, right? Now, we don't necessarily have a lot of dispersion right now between prices. The swine and pork market formula, the weighted average was roughly $80 per hundredweight. The other purchase arrangement was roughly $86. Other market formula, which is futures-based, $87. So roughly a $7 range there. But depending on how I sold those hogs, certainly that impacts, what prices I have, and there's varying percentages here. So we've seen the swine and pork market formula come down. The other purchase arrangement has come up. This is where my understanding Prop 12 compliant hogs will be categorized by USDA in that category. So this potentially is going to start to increase in a volume standpoint. And they'll remind us that Packer-owned hogs represent roughly 40%. I'm going to come back to that and highlight when we talk about Packer profitability there. So I'll highlight, this is a tool one of my graduate students, Ezra Butcher, built that helps kind of show that price dispersion. So you can go check this out on our Iowa State CARD website. You can pull up, it's kind of like a drought monitor. You can pull up prices and compare those year over year or week over week to see that dispersion. So I'll highlight here, at least one producer got under $60 per hundredweight last Friday, and at least one producer got over $112 per hundredweight. So quite a bit of variation there on how I discover those prices, and obviously that impacts my profitability. Also, we talk about risk management. So we went from late December, June 2023, lean hog contract was trading roughly 109 and it's gotten down to the 80s, right, range. There was opportunities back in late 2022, early 2023 to lock in roughly break-even levels, given what prices were trading at that particular time. Now that was locking in some modest profits at times, some modest losses at times, but obviously that looked rather favorable compared to where markets are currently at, right? So I think there are some opportunities that producers did offset quite a bit of risk. Futures prices have been in that slide really since March. I think there's some indication that markets could go lower. I like to look at volatility smirks. I won't bore you with the details, but the more you smirk to the left, the worse it is, right? And that blue line compares to a month ago. So that blue line says there's potential to see lower prices and risk to the downside. Now the cutout value, and this very much aligns with the demand story, is we've seen very flat cutout values trade right in that $80 range. It's really been an indictment, on the belly, we've seen the ham, the rib, and the loin considerably lower compared to year-ago levels. Now, some of that I think can be explained by cold storage stocks, or at least that's a good indicator of movement of that product, demand of that product. We've seen hams and bellies notably higher than a year ago. Ribs have, although, been notably lower than a year ago. Now, packer margins, so it's not producers just losing money. Packer margins have really turned red, especially as we got into late 2022. This is my measurement of a net margin. And then I want to highlight this integrated margin here. So that's where I take the cost to produce hogs instead of what I could buy hogs on the open market effectively. So remember I told you I was going to come back to that when we talked about producer versus packer-owned hogs and the weights of those hogs. Well, I can go buy hogs a lot cheaper than I can produce them right now, right? And I think that's why we've seen really hog supplies, producer-owned hog supplies be pulled on because of the availability and cost relative to what I can produce those hogs for myself as a packer. So last two slides here. So Dr. Meyer sent his slides, and he said, well, these are the two summary. Do you agree or disagree? I said, well, I agree with them. They're pretty good. So we're going to use those. I'll give maybe the short-term outlook, because that's easier. And then Dr. Meyer will give the 3 to 5 year outlook. Then we'll take some questions.
I'm real good at that. Yeah.
I think consensus that we're going to see a smaller sow herd. I think the question is, how much smaller? Certainly a lack of growth. Question, do we see larger litter sizes? I think the potential is there, but history would say, we've really kind of plateaued, at least recently. Potential in aggregate litters per breeding animal decline. We've already seen that in the USDA data, and maybe some potential there as we talk about Prop 12 and at least short-term impacts of that as there will be more learning by doing. Slow growth for exports. Dr. Meyer talked a lot about that. And, I was asked, what are the game changers for 2023 and beyond? I think it's demand, demand, and demand. So I think that's a key issue going forward.
Number one on the list of risks that we face is always this. Can we keep a foreign animal disease out of the United States? If you recall, when ASF showed up in the Dominican Republic, 4 years ago now? There were people that said, I think that happened in the spring, said it'll be here by July. And there were smart people that said that. And I was kind of going, that sounds a little odd. But we have certainly increased our mitigation and detection efforts since then. I think it's a testament to what they've done at the borders and at the ports and at the airports that we haven't got it. I'm optimistic we can keep these out of here. We've done it for a long, long time, even with it very close by our shores. So that's still the big deal because the probability of it is extremely small, but the impact of it is huge. I mean, if we had to start consuming 23, 24% more of our product tomorrow because it couldn't get exported, it would not be a pretty sight. Long-term labor supply for both packers and producers, still think that's an issue. It's one of the reasons we haven't seen growth in litter sizes is we didn't have enough labor in these farms. The point I would make on Lee's thing on the litter size is during that time period where we have not grown litters, the genetic capability of the gilts going into our herds has gone up by 1 to 1.5% every year. I mean, the genetics companies keep making improvement on that trait. And yet we're not even getting back to where we were 4 years ago. So if we start capturing the capability that are out there, then leave the growth rate for 2 or 3 years, maybe 2% plus. But we've got to get disease under control and we've got to get labor in those barns. Physical capacity growth or just maintain. I mean, we were looking, well, maybe we're going to get some growth. We're going to double shift. We had 3 plants that we could double shift. And now, especially with the closure of Wyndham, it's can we maintain? And those margins that Lee talked about a while ago at the packer level, they have called into question whether we're just going to even maintain the capacity we have. We need what we have now this fall, no question about that. So it's going to be important. If we ever get back into a growth mode, the thing that has to lead the way is some capacity. We had 2 plants, Prestige and Holstone, who had double shift capabilities, but they're going to be busy merging those companies for quite some time. They're not going to get double shifts done. Coldwater could add a double shift, but they've got to do some things with coolers. The new plant that Holstone had planned in Sioux Falls, That's pretty much, pardon me, yeah, Sioux Falls is, I get Sioux Falls and Sioux City
Me
mixed
too.
up too often. Sioux Falls is pretty much on hold, so there's no real potential for capacity growth, at least in the foreseeable future. And finally, that price discovery system. We still have a lot of our values discovered by that negotiated market that is now consistently less than 2% of the pigs that are sold on a given day. So I still think that's going to be an issue coming forward.